I'm Mike Ludwig. I'm a director and head of healthcare technology at MTS Health Partners. We're a healthcare-focused investment bank based in New York. We have a great panel here, a mix of healthcare-focused investment bankers and investors across healthcare, so life sciences, healthcare services, and healthcare technology. In the interest of time, you've got their bios in the brochure that you've received, so I'll briefly introduce them, and then we'll hop into some background on what we're seeing in the market, and then some questions. So to my direct right, Ray Falci, longtime healthcare technology-focused investment banker, now a senior advisor at Cain Brothers, a Keybanc capital company, and also recently a faculty member at Columbia Business School teaching a class on healthcare IT. To his right, Dan Gebremedhin. Gebremedhin. He told me, and I still got it wrong, of course. So he's a principal of Flare Capital Partners. They're a couple $100 million fund, I believe, focused on healthcare IT and healthcare services investing based in Boston. To his right, Sooin Kwon, partner of mine at MTS, who covers life sciences advisory, focused primarily on M&A and capital raising as well for biopharma companies. And to her right, Drew Schiff, managing partner at Aisling Capital, a life sciences-focused investment fund. So with that, to start, maybe just a couple minutes for some context on what collectively we're seeing in the market. In terms of fundraising, we've had a record-breaking 2017. So both in terms of digital health, healthcare technology, and life sciences, it was the most money raised in each one of those sectors ever. So in healthcare IT, on the healthcare IT side, there was a 40% increase over 2016 in terms of the amount of capital raised, about $5 billion. And in New York City, there's actually 80 companies that raised about $700 million in funding. So you're seeing a ton of interest both in traditional tech, healthcare, and then life science investors even focusing on healthcare technology. On the biopharma side, investments in venture-backed biopharma, med device, diagnostics, and tools increased about 30% over 2016 to about $16 billion. Most of the focus was on some platform companies that we'll talk about, oncology and certain other areas of focus. But the M&A and IPO markets have actually been not as robust, particularly last year. So no IPOs in terms of healthcare IT last year in 2017 for the first time in about 5-6 years. And on the M&A market, even though you've seen quite a bit, about $25 billion over the last 4 years poured into digital health broadly. Not the amount of exits in terms of maybe until recently, in terms of yesterday from Flatiron Health, but not the amount and volume of M&A exits you'd anticipate for the amount of capital that's been invested. Life science is a bit different. You've had a few very good years, although again, last year was a bit of a blip relative to before. So with that, as some context, I'll open up with a panel. Given the amount of investment that's gone in both on the life sciences side and the healthcare IT side, where do you think we are in the investing cycle, both in terms of valuation and then just generally? So I'll start with Drew.
Well, I would say we're probably not at breakfast, maybe a little closer to dessert, but hopefully not at the end of the meal. We're in a little bit of a different environment than we've been in before. To give some context back, and people like to refer to 2000 or all the way up to 2008, many of the life science companies during those days were science-focused and may not have had a clear path to development of a drug. Virtually every company that's going public these days has a clinical path to a drug approval, and the quality of the underlying clinical and preclinical teams at these life science companies has increased in quality substantially over sort of the last 10 years or so. So I think the fundamental pillars of our sector have strengthened. Still, it's hard to ignore that we're back at the 2015 highs. The sector's up 5% on the year in spite of volatility throughout the market in general. And I think one has to be cautious as one looks at sort of valuations that seem, maybe well priced, if a bit high at the time of the public offering, and then trading up substantially after that. As an example, and with all due respect to the company, because I think the technology is extremely interesting. There was a gene therapy company that went public recently. One of the pillars of gene therapy had resigned from the board just days before the offering, and they had to update their filing before the offering with a clinical hold, and yet the company soared on its offering. So, I think you have to be careful in the market these days, but having said that, I believe that the underlying quality of companies in life sciences has improved steadily over the last years, and we're looking at a very high quality group of companies in general.
So we'll stay on the life sciences side. I don't know if, Sooin, you want to comment as well?
Sure. I agree with Drew. Definitely the fundamentals are strong in life sciences. I'm talking specifically about therapeutics, where we've got, great FDA headwind in terms of approvals, much more clarity and I'd say confidence that these products are going to be approved. So that's very, very positive. I think what's also, just in terms of, the capital raising environment, because it's been so robust, these programs have been, they haven't been funded on skinny budgets. So they've been actually done, they've been done properly with a belt and suspenders type of approach. So the fundamentals are great. That being said, I want to, I don't mean to be, Eeyore here, or, too much of a bear, but, we are in a momentum market. And I think, if you look at, the IPO trends and the M&A trends, that is the thesis for investing for both private and public investors, because they will have exits. But at the end of the day, the biotech markets and life sciences markets, rather, are, the valuations have gone up. And I think, what I'm hearing in the markets is that, especially public investors, even though they can't justify valuation or certain fundamentals, they feel like they need to participate in order to beat their benchmarks, and that's a worrisome trend. One of the things I just wanted to point out is, in terms of biotech IPOs, the reason why, I try to look a lot at, what's going on in the biotech IPO landscape is because I see that asset class as really a leading indicator of the market. Because if you think about it, it's the one asset class where public investors are really trying to juice up their performance, by investing in biotech IPOs. And, the IPO that Drew mentioned, I think that was unprecedented, really, that a company that had to update their filing with a partial clinical hold and had a clinical advisor resign, all sorts of stuff, that it's still priced and did very well. So we're seeing investors kind of chasing those returns, and we're also seeing new investors who have never really invested in the life sciences market start to really spend a lot of money in it. So, I'm talking about investors like, Google Ventures, various investors who are, I'd say, new to life sciences. And at the end of the day, life sciences, biotech, there's the fundamental truth is that not every product is going to make it through their clinical trial successfully. And so what I worry about is that we're going to have a string of, clinical trial failures, which will, may impact the market. But at the end of the day, we still have some overall very positive tailwinds to the overall industry, which I think will buoy it for a while.
So Dan, maybe on the healthcare IT side, what are you saying?
Yeah, I guess I'm a little bit more optimistic on the health IT and services side. I think that there are a lot of similar dynamics with respect to valuations being stretched, new capital, perhaps undisciplined, coming into the market. I think that there is a bit of a kind of fear of missing out mentality. Many companies are staying private longer, and so you have large investment firms like Fidelity kind of coming down market. And investing. That said, you said $5 billion, depending on who's counting, over the last few years, digital health has been, acquiring a lot of investment over time. And I think there's a reason why that is. It's not, people chasing valuations per se. I think there is a creative destruction that is actually happening in our healthcare system, and we are actively rebuilding it ever since, the passage of the ACA kind of in the 2010 timeframe. That's where you've seen 30% year-over-year growth. The M&A market is still very active. I think we had over 100, transactions last year. And again, I think that there's a lot of early stage capital coming in, so there's a lot of kind of point solutions out there, and then I think that, sets itself up for more M&A transactions.
Right.
Yeah, I think, not to reiterate too much, but picking up on one of Drew's points in the healthcare IT world specifically, looking back at last cycles, I think what's constructive about, the fact that there were no IPOs, for example, in the health IT world last year, is that the public markets at least have put a higher barometer out there, a higher benchmark to get a company public. I was involved in 9 IPOs in calendar year '99 when I was at Bear Stearns, and honestly, only 2 of those 9 ended up really becoming companies that had sustainable, business models, because frankly, in those days, the bar was much lower to go public, and I think the most destructive thing to the whole ecosystem is for companies to go public prematurely where they can't withstand the scrutiny. Conversely, I think all the money going in on the digital health side from all the private investing, the other positive thing I see there is while the numbers are up huge, the average investment size has also gone up a lot, which you hope gives a lot of these companies the staying power to get through the normal, speed bumps that you're going to see with any kind of an early stage company, which again, we haven't seen at other points in the cycle, in other cycles.
Yeah, I mean, to follow up on that, there's been, one of the things you're seeing is not just new investors coming into the space, but the amount of capital they're raising is relatively, over the past 20 years, more significant than ever, right? So if you folks like Temasek, SoftBank, companies raising at $100 million round, $500 million, billion-dollar rounds, right? So these are, pre-money valuations of a front-end company with a pre-money valuation of $1.5 billion for a Series A. So what does that imply, right? From an entrepreneur perspective, if you see that out there and you've got a competitor that's raising $500 million and you're going to raise $30 million, right? What does that do from an entrepreneur's perspective, and then obviously vice versa from an investor perspective? How, Drew and Dan, how does that change your viewpoint, if at all, in terms of companies that you're focusing on?
Yeah, I mean, I think that there is a certain sticker shock associated with entrepreneurs raising kind of large amounts of capital at high prices. I think at the other side of that kind of equation, though, sometimes some of these businesses require it, right? They're just capitally intensive businesses. Again, we have a portfolio company that's a health plan, Bright Health Plan, and they raised a $160 million round because in order to start a health plan, you need a significant amount of reserve-based capital. So, and then I think you were referring to Grail, right? Again, another very capitally intensive business with a very, very broad mission. And so I think perhaps in some cases it is warranted, but I think to your point, there is a certain sticker shock associated with that.
On the biotech side, in the private unicorn area, as I think about it, the only private unicorn that's traded is Stemcentrx last year for $2.5 billion, and all of the others have yet to trade at valuations in excess of their capital raising. So I think that in life sciences, also the capital intensiveness of the business, companies have elected in general to go public sooner to have access to capital, not only at the IPO, but to more easily access capital in an ongoing fashion. And not to put too fine a point on it, but in the private world, you can get trapped in the multiple layers of preferred stock and sort of stacking issues and dilution and anti-dilution issues, whereas if you're a public company, you're almost always raising common stock. It might not be at the price you want it to be at, but you're raising common stock and all your investors are treated equally. So you have issues of capital access, but the capital access issues are usually expedited. By that, I mean people like Sooin can help you to go out and raise capital in a relatively abbreviated fashion. Life sciences is rarely a linear path to perfect drug development from inception. So, if you're a private company, it's a little bit rocky. Your access to capital might be more constrained. And then finally, I would say having a lot of cash on your balance sheet actually enhances your chance of M&A, because it signals to large biotech and or pharma that you mean business. You mean to launch your product, and you mean to go directly at them in a market in which they might exist, or you mean to create a new market that they might be interested in. I don't know, Sooin, if you would.
Well, I definitely agree. It's good to have a lot of capital on your balance sheet for sure. I think it is very strategic. But I do worry about, especially the entrance of a lot of these new investors who haven't historically been in life sciences. And I do worry about large valuations and large valuation expectations, because at the end of the day, they're going to have an exit. And that exit's going to be an IPO or M&A. And that is really what drives all of these investments. Along the way, you're going to have to monetize those. And if you're not able to fulfill the prophecy of what you had set out to do, your investors will be disappointed. And that really is a slippery slope and can cause really the kind of beginning of the end of a fund if you're not really delivering on that. And so I worry as a banker of really kind of meeting those expectations of, being able to deliver those valuations for companies in terms of financing rounds or trade sales where the private investors are getting the returns that they need in order to deliver what they said that they're going to do for their investors. And I think that that's something that as we keep on going, we can't go straight up. Right, so it's worrisome.
I think you make an excellent point. Just as an example, I think to use an example, if you're starting a biotech company, you raise $100 million in a Series A round. All of that capital expects at least a 3x return. So you now need to sell your company for at least $300 million. But if your drug is very early, let's say you're 2 years later, you need to raise another round or you go public, you may not go public at $300 million, you may go public at $200 million or less, raising another round and you can't raise $100 million at that point. So you definitely, in my view, I completely agree, you need to set a very clear path around how much capital you're going to raise and the expectations of where that's going to get you.
So shifting to investment focus, so given the amount of money raised, where are investors spending time? We'll start here on the healthcare IT side in terms of key themes and where you're spending time specifically.
I think kind of writ large, the early stage private equity, markets in healthcare, I think have woken up to the opportunity in complex care and high cost populations. And so you're starting to see a lot of kind of verticalized, care delivery, hybrid care delivery, health plan coverage, startups locally. There's a company called CityBlock that just raised $20 million, no customers, at this point, again, early stage customer, business, but is able to attract a lot of capital. And I think that, you'll see a lot of, again, there's certain, kind of Me Too aspect of early stage investing, or you'll start to see a lot of health tech venture funds all have their own Medicare Advantage plan, like we have Bright. There's Oscar, Clover, Devoted. They'll have their PCP primary care play. We have Iora. There's kind of Alignment, ChenMed, so on and so forth. So I think it's areas around high cost populations is where you're starting to see a lot of early stage capital, kind of migrate to.
And I guess 2 points I'd make. One, taking Dan's point even just a step higher, just the concept of it's sort of an established, trend now that we're moving away from fee-for-service to some kind of value-based reimbursement, which has so many implications for sort of everybody in the healthcare ecosystem. And whether you're a payer, provider, whether you're in any end of the spectrum, you're going to need to redefine and retool your business model pretty materially. And so that creates so many openings. And to that, the second point that I'd point to, obviously for a lot of recent investment, has been on the consumer side. And the whole concept around social determinants of health and other ways of helping patients monitor themselves in the home, helping them track themselves, helping whoever is at risk for their health better monitor them remotely. There's so many different ramifications of that as a trend that there's a ton of money going into that. And all of it, it's pretty early stage at this point, so it's very fragmented, many different ways of attacking that.
Great. And on the life sciences side, start with Drew.
Well, I would say, I wouldn't say, I think most people have recognized that the area of oncology in particular has garnered a huge amount of focus. But if you step back for a second, that underlying that is a general focus on targeted new therapies. By targeted, I mean that specifically identify patients who would benefit. and by doing so, understand the mechanism of the disease, and the drug itself, in most cases, provides more effectiveness and less toxicity. The one area of oncology, of course, that doesn't really apply to is immuno-oncology, where some of the newest therapies by Juno and Kite certainly have a fair amount of toxicity, but a really remarkable result. And then gene therapy, which literally you couldn't say the word 15 years ago, or people were like, gene therapy, we can't do that, has now become the coin of the realm again, and everything with gene therapy obviously works. But it's very interesting in that gene therapy 2.0 has become, I think, much more advanced. Both adeno-associated viruses and lentiviral vectors are being used. There's some appreciation for the amount of vector that can be given to patients, and that potential range, and of course, the tremendous efficacy in companies that have made their way into later stages of clinical trials or even to FDA approval has been remarkable.
So I would add, in addition to oncology being probably, the hottest area in terms of both private and public investing, still orphan indications, orphan diseases is still very, very attractive, attracting a lot of capital, still, an active M&A environment for them. Really what we're seeing kind of overall is just emphasis on new chemical entities and, novel products, novel platforms, gene therapy, cell therapy. I mean, like this yesterday, Cellularity, this Series A, $250 million raised. I mean, that's a crazy amount for a Series A. Cellular therapy spin out from Celgene. And cell therapy, again, 15 years ago, nobody wanted to hear a thing about it. And all of these technologies are, all of a sudden, there's a product that has proved that it can work. And payers are showing that they will pay for it. And that's the other part of the equation is, how do you price these things? So, that's where we're seeing a lot of the investment. I think these days I'm seeing less interest in some of the reformulations unless there's really some kind of like efficacy advantage or some real clinical benefit that they're getting. In devices, a lot of the devices are kind of IT related or linked, so monitoring equipment like hardware, software types of combinations. So I think that's the general laundry list of where people are spending time.
Great. And then what you're also seeing, particularly last year, is some of these transformative acquisitions. You've got CVS, Aetna, things like United Optum going to primary care and buying things like business from DaVita, rumors around Amerisource. So how does that, I guess the main theme is vertical integration, scale, and even some consumerism aspects with CVS, Aetna. From an investment landscape, I'll say on this side of the table, how do you think about competing against scale for one, or just general industry trends in terms of consolidation when you're investing, with early stage companies? So, for example, let's talk about Bright and Devoted and MA plans. When you've got United, who has 35 million members, how do you compete against that in some respects?
Yeah, I mean, I think it's really important to, kind of keep one eye on what the large players are doing. And, if you're going into a business model where, kind of scale wins the day, it's going to be really tough to, compete with them. And so I think you need a differentiated product, right? And so I think we think Bright, from a health plan perspective, is a very unique, differentiated product where a health plan is essentially white labeling a health plan solution for a single provider partner in the market. And we think that model would be attractive to, a large, kind of consolidated player like a United or, a Humana for that matter.
Yeah, I think the point I'd add, I've advised investors like Dan many times. The good thing about the trend you just described, Mike, is if you can build a differentiated model, that you have a lot of exit options because the big entrenched guys are going to need those capabilities. And I think conversely, the fact that the big guys are doing these transformative acquisitions tell you that they've identified holes in their portfolio and holes in their go-to-market strategies and other things that they need. And again, to sort of pile on with the point I made earlier. When the business models are changing so dramatically and risk is shifting to providers, and we have whole different ways of engaging patients and so on, almost by definition, it suggests to me that the big entrenched guys are not going to be able to react to that as quickly as a small, younger company can. But then ultimately, when they need to get in, you'll have a nice exit if you were the fortunate one to build that successful model.
Yeah, and I mean, I think it's a net positive, right? When United and Optum acquire, kind of a $6 billion, set of medical groups, the DaVita Medical Group, which used to be called Healthcare Partners, all the other major players, say, well, what's our provider strategy, right? And then that just naturally leads to other potential M&A. Again, I think, venture portfolios oftentimes are the beneficiaries of that if you have these types of assets that these large players are looking for in your portfolio.
Great. And then on the life sciences side, obviously, something everyone's concerned with, not just in life sciences, is the administration. So the Trump administration and the FDA. I think Trump came out relatively recently and called Scott Gottlieb a star, quote unquote. I don't know if that's fake news.
I don't know if that means anything.
Or what, right, exactly. So, Sooin, Drew, what's your take been just in terms of the administration currently, in terms of both on the pricing side, but also the ability to get approval through through the FDA over the last year or so, and then going forward?
Well, on one hand, I mean, the FDA, I mean, it's amazing and unprecedented how many approvals and how rapidly they've approved products, and a lot of that is partly because of some of the initiatives that were put in place years ago, like the breakthrough designation program, et cetera. So that's very positive. I think, from what I understand, the thesis, though, is to really get more drugs on the market with broader labels, and so there's more competition in the market so that you don't have as many monopolies as you did, and to really empower managed care and payers to be able to substitute drugs and have more flexibility in negotiating that pricing. So on one hand, it's great. There's also the new GDUFA program, which relatively new, which means that more generic drugs are going to get approved, and that's becoming and has proven to make the marketplace even more and more competitive. And I would actually say that that's probably been negative for the generic drug industry, whereas the branded side, it's been a boon to them. There are a number of generic drug companies who have actually suffered in terms of pricing and various commercial aspects of their business in terms of the multi-source generics business. So that's been kind of a negative side of the FDA, if you will. I mean, it's positive for consumers. But I think at the end of the day, all of this boils down to more competition, more pricing. And, here you've got Trump, who's a Republican, but in 2020, you could have potentially a Democratic sweep. And if so, then pricing will become even more of a hot button topic than it is now. So it's just something to look forward to.
And also, and also to just sort of pile on for a second, the last time pricing made it into the headlines prior to the most recent presidential election, that, along with Martin Shkreli and Valeant, managed to take down the biotech market about 25 to 30%. So it's in everyone's interest for the discussion to sort of evolve on the most logical of lines. I'm interested. Lately, I'm by no means at all a expert on pharmacy benefit management, but it was interesting to me that states like Kentucky and other states are trying to do away with or streamline pharmacy benefit management. And I wonder, with regard to Amazon or CVS Aetna, whether there's going to be a level of transparency in drug pricing that may ultimately help to bring this discussion to a logical conclusion. And by logical conclusion, I think that brand new therapies that are novel and have tremendous clinical benefit, and I guess I'm speaking from my own personal opinion as a physician, brand new therapies that have significant clinical benefit and keep people out of the hospital, and people no longer have to have liver transplantation in the case of hepatitis C, or extended stay in the result of sort of, end-of-life cancer treatments or what have you. Those therapies, I can understand why they should be priced at a premium. why Me Too therapies that are comparable to existing therapies that are much less expensive should enjoy the same pricing benefit, I think is going to continue to come under a fair amount of attack, and I would expect that to kind of move through the system.
I mean, I think from an IT and services perspective, we're ultimately investing in businesses that are trying to kind of bring down cost in the healthcare system. And I think I've been kind of meditating on this thought. It's something I've heard of before, that the problem in the healthcare system isn't so much cost, but it's price. And I think there's a huge opportunity to create rationalization in drug pricing. We actually have a portfolio company called Aetion here in New York that is focused on real-world evidence analytics to evaluate the true outcomes, the financial outcomes of a drug. So I think that there is a real opportunity there, and I think the FDA is being very kind of welcoming of real-world evidence and the use of real-world evidence in kind of simulating randomized clinical control trials. I think from a health IT and services perspective, I think our venture fund purposefully tries to avoid the FDA. That's why we are investing in IT and services. And so I think it does make us a little nervous that the FDA wants to start kind of monitoring digital health programs. And some of the early language that they've put out suggests that there's a specific type of digital health that they want to monitor. So systems that autonomously diagnose and treat. So anything that is computer vision related will have to go through the FDA. So I think having some real clarity there, I think, is helpful. But at the same time, I think we're a little nervous about the FDA, kind of, monitoring the software industry.
Yeah, I mean, so last year, what you're alluding to is the FDA came out with a digital health certification program where they didn't actually approve the platform or the product, they approved the company. So the company, like an Apple, for example, is one of them, they're able to iterate on the product as you would in software, but essentially they have approval broadly, but not for the specific product. I guess one question, is that enough clarity, right, in terms of if you're a digital therapeutics company, for example, which actually does illustrate the convergence of pharma and software, is that enough, or what do you expect from the FDA in terms of more, in terms of approvals and regulatory pathways? Maybe start with you.
Yeah. Oh,
please go, Ray.
No, I was going to say, I think there has to be more. What's interesting is the FDA, until very recently, didn't do much in the IT world, but it was an esoteric area. Blood bank software was like the only pocket of healthcare IT as long ago as 15 years ago that the FDA regulated on the grounds that if the system monitoring a blood type messed up, you could give the wrong blood to the wrong patient, and you could have, obviously, pretty bad ramifications. But the FDA always sort of drew the line that if the IT system wasn't impacting the delivery of care, it was more of a record-keeping information storage, mechanism, we don't need to get involved. A lot of these new models are obviously crossing over that line and crossing pretty far over that line. And I think the FDA is going to have to start, it's going to be more in their purview to even dial it up further, and I appreciate your concern for what that could mean for the space.
I agree. I think you're absolutely right, Ray. I mean, AI, right? The promise of AI is, autonomous decision making, and so you can see that, depending on, to your point, the administration and who's in power, I think there may be a really tough regulatory stance, or it may be a more laissez-faire approach. But a lot of the investments that we're making really depend on technology to scale these offerings, and so it will definitely impact it.
Yeah, I mean, on that, I think one of the general themes is convergence, right? So particularly within pharma, software is sort of an enablement layer everywhere. More specifically in digital therapeutics, you've got clinical trial software. So on the life sciences side, just moving over there, I mean, what are some of the companies thinking about in terms of investments? You've got folks like Merck with GHI, J&J, Pfizer, Sanofi. I mean, a lot of the folks have actually direct investment funds into IT, or they're thinking about across their portfolios how to leverage IT. How does that on the life sciences side start to influence some of the companies that are pure biotech or pure pharma as they go to raise capital or thinking about exits?
That's a tough question. I would say, it hasn't influenced it, I would say, directly. I think a lot of the initiative in, big data, et cetera, is really, being factored in terms of operations and, improving probabilities of success and managing costs, et cetera. But in terms of being part of the investment thesis of investing in a life sciences company, that has not yet become a driver. maybe it will in the future, but for now it isn't. So I think that, if that is kind of your investment thesis, that's where you'd be investing in healthcare IT or, companies that directly service those types of clients.
Yeah, or maybe like a parallel to big data in biotech is the use of CRISPR, other technologies like CRISPR, to build mice that, in the past took a long time to build, but now you can build a whole bunch of them in a relatively quick period of time. Or just sequencing, which was, we could sequence one genome in 2000, 2001. Now we can sequence practically anything in a relatively short period of time. And sequencing of cancer, of tumors is, more the norm than not the norm, and certainly occurs at every major cancer center. And I think all of that has resulted in, and the way that that's changed clinical studies, particularly in cancer, but also in other areas, is we used to think of cancer as, it's lung, breast, liver, kidney, what have you, and not to say we don't run studies in those solid tumors, but now increasingly you're subtyping those cancers, directing them, so you have what are called basket trials. Basket trials are you take blood, figure out who has one mutation, whether it's like RET or whatever it is, and then you bring all those patients, no matter where their tumor is, into a study just based on that mutation. So that's a way to think about the utilization of patient-specific data to create a clinical subset for a study. Interestingly, an area of a disease area called amyloidosis, which for many years it can occur in many regions, but let's just take the heart where it's pretty mortal. People have cardiac amyloidosis. It's this plaque that exists in their heart. They have heart failure. It's very uncomfortable. And years ago, the only way you could diagnose this was to have a heart biopsy, and not a lot of people are running to have one of those. And now you can just take a blood test, and it's not available everywhere, but at the major medical centers, and someone that comes in with symptoms of heart failure, take a blood test, you look at their blood, you determine if they in fact have not symptoms, but if they have the genetic alterations consistent with amyloidosis and even subtypes of amyloidosis, and they may get different therapy based on that, which is a fundamental shift in how we think about treating disease, and very, very exciting.
Yeah, I guess just to glom onto that, the big difference that all of this computing power has given pharmaceuticals is really being able to diagnose these patients, be able to select the subtypes that are going to respond better. So really, we are truly in the era of personalized medicine because of all this data. And I think that's the reason why, we're seeing such great innovation because of this. But I wouldn't say that you can kind of directly kind of see the software and the technology that enabled it, but it's kind of gone hand in hand.
Yeah, and just to add one more technology, we talked a little about Grail, which is sort of a unicorn valuation. Putting the valuation aside, the underlying science of liquid biopsies, or the notion that there is free-floating tumor fragments of various specific kinds in a patient's blood, and you could detect long before they had a recurrence of a tumor in their blood some cancer fragment that would tell you that that patient is becoming resistant to the therapy and should change therapy is incredibly fascinating. Now, I'm not close enough to Grail to know where they are and all of that, but that is a very, very important and interesting clinical objective for patient care.
Michael, I just wanted to say blockchain. That's it. That's all I wanted to say. We're naming technologies here.
But I will say one of the themes here today, obviously, is data. So besides blockchain, which that aside, within that focus, if you forecast, say, 5 years from now, right? I understand that currently, the worlds haven't really converged. But you do have things like Flatiron. You've got two guys who sold an ad tech company to Google selling oncology software for $2 billion yesterday, right? So they have converged, right? You've got Axovant, which, say what you want about the first trial, they're building Datavant to look at, trials and molecules and drugs that Big Pharma may have forgotten about or just not focused on, taking them out, buying them for $5 to $20 million, and then going public at $2 billion. Leveraging data techniques to actually find that deep within the companies that weren't focused on. So kind of fast forwarding, what will you see 5 years from now, right? Is it within clinical trials in terms of virtual clinical trials? Is it refocusing with software on certain areas that biotech and pharma have not historically focused? What do you predict 5 years from now in terms of leveraging data within, let's call it, the life sciences world to start?
Well, I would say first, keep in mind that the only thing in common between biotech and tech is the word tech, because there is no disintermediating in biotech. The FDA, which we've talked about, is standing smack dab in the middle of that, and on the other side are all of the insurance companies we're talking about. And so once you make it through, you can use all the data in the world. You still need to run clinical studies to make your way through. And medicine, for the most part, is we often, when you're practicing medicine or going to medical school, you're kind of building on the shoulders of other people who have come before you. Many of these therapies that are being talked about today in such reverent fashion are therapies that have been around for a number of years but needed to be perfected over time. So I think the biggest shift that we're going to see over the next 10 years is the majority of new drugs developed will come from life science companies. It's already trending that way. Last year's drug approvals, while many of them occurred in pharmaceutical companies or big biotech companies, many of those drugs at inception were life science companies. And so the biggest shift is this movement where the engine of development is shifting from pharma to biotech. It's not to say that pharma won't develop drugs, it's just shifting to biotech. And the one subtle part there is I think that many people, professionals who were clinical developers or scientists or chemists or physicians who 10 years ago would not have gone to a biotech company by virtue of the uncertainty that it meant for their career, and would have chosen to go to a large pharmaceutical company by virtue of the security that offered, their mindset has now shifted. And so I think you're going to continue to see the very, very talented people in our industry shifting towards biotech directionally from pharma.
So to add on to that, I think all the big data and diagnostics and tools and what this is enabling is that we've got these historical probabilities of success. I'm sure you've all seen the statistics, FDA, the Tufts Center, they all publish those. I mean, maybe what this will enable is that instead of a 60% probability of success of phase 3, you've got a 65% probability of success. So you do kind of shift things on the margin. So I think at the end of the day, 5 years' time, you are probably going to see, more. I mean, we're already seeing it, really just, true novelty. You're going to see more. I think, CNS is an area where there's been very, very little innovative in decades. And we're starting to see early investment in innovative CNS for the first time, and it is enabled by a lot of this technology. And I think in 5 years' time, we are actually going to see some innovative therapeutics in CNS come out. Right now, I think we're in the age of oncology. Think about it, 20 years ago, all you had were really cytotoxics, right? And now, 20 years later, I mean, the whole landscape has completely changed, and it's amazing and gives me goosebumps. And I think we're going to see that in CNS. So that's my one prediction. I don't know, 5 years, maybe 10 years.
Great. And so earlier you alluded to, the amount of investment has been large, but ultimately the investors want to make money, right? They want an exit of some capacity, either through M&A or an IPO, although it's not a full exit, it's a path towards liquidity. So let's focus on M&A, maybe start with the bankers who do that for a living. There is a lot of noise in the market, just from a specific product perspective in terms of life sciences, software, or, trends, Amazon, new entrants, et cetera. How do you sort of cut through that when you're actually representing a company from a positioning perspective? How do you get a buyer engaged, and how do you get a buyer to pay up? Start with you.
Sure. I think the key is obviously identifying the most unique element of your client that you can identify in several strategic buyers as a whole in their portfolio. And what I've found over the years is you don't necessarily need, full breadth and full validation of that, across, say, the whole country. But if you can show in a few markets and a few instances that this technology or this approach or this combination of technology and services can produce better outcomes, can engage patients more effectively, whatever the goal of the business model is, you're going to find a strategic buyer who's going to say, that's something I need to round out my approach to going to market and however I do. And so, I've consciously advised clients over the years that I'd rather see you be a mile deep on proving one aspect of your business model than trying to be a mile wide on doing a lot of things to a lot of people. Because as long as you do that one thing really, really well, assuming it has a good definable value proposition and a good sort of return on investment to the customer and those kind of criteria, you're absolutely going to find big strategic buyers who are going to be interested. And that's what I always hone in on when you're preparing the marketing materials and when you're out, representing your client.
So, a couple things. At the end of the day, nothing really for life sciences companies can beat the data. I mean, whether the data is high quality or not. I mean, it's not just about the top line that you've reported, but, all of the underlying statistics and the rigor of the study and all of that kind of stuff. And frankly, as bankers, there's not that much we can do to control it. But one of the things that I harp on with all of my clients and people I talk to, and this drives me absolutely crazy, is that a lot of these biotech companies and spec pharma companies, they're so focused on clinical development and they spend no time or money on understanding the commercial marketplace, pricing, about truly, understanding the commercial market. And then, yet they say, well, we've got, we hit the p-value, somebody should want to buy us. And, meanwhile, they're letting the pharma companies, these large companies, do their own market research, have to interpret this data and turn it into a forecast. And I'm like, isn't this worth your time and money to really put in the effort to be able to defend a robust forecast in the market potential, especially if it's a marketplace that doesn't, really truly exist yet. You're making a new market, et cetera. And I think a lot of life sciences companies, they run, a lot of them are clinicians, et cetera. They don't have a very good commercial mindset. And so, my big thing that I harp on is, you really need to, even if you don't hire a chief commercial officer early, you have to have good commercial consultants, good managed care consultants, good market research. It really can pay off, even if you don't have a lot of data. If you've really fleshed out the commercial marketplace and you're credible to a larger company, you will get bought.
Yeah, I'd say from a buyer's perspective, we have our own portfolio companies doing M&A, right? And so I think we think about it from, the acquirer's perspective. And I think generally speaking, it's usually one of two reasons as to why, a company gets acquired by a much larger player. You're filling a much needed gap, right? That, the strategy is incomplete. And or you represent an additional revenue opportunity down an existing channel. And so I think, kind of investing with that in mind and understanding what the asset value actually is of said company, I think is really important.
Maybe one last question, then we'll turn it over to Q&A. From the investor side, I've had investors tell me that if an entrepreneur comes in and starts talking about an exit at the Series A or Series B level, I'm not investing because it ultimately shows that they're not in it for the long haul. I've also had investors say that we need entrepreneurs to be acutely focused on that because ultimately that's how we make money. So what's your perspective from the investor side on the life sciences and technology side? How soon does that enter your thinking when you're making an investment, if at all? And then from an entrepreneur's perspective, should they be thinking about it? Should it be in a pitch or not?
Well, there's, I guess, I don't know if it's an old joke or new joke or just a joke about biotech that every biotech company is always for sale. I think that I agree with all of Sooin's comments on this. I think that certain areas of medicine, it's virtually impossible to think about a biotech company actually launching the drug. So primary care markets for depression, for an oral antibiotic, for pneumonia, a new drug for heart disease that's broadly based. I mean, you're talking about fielding a massive sales force, a huge amount of cost. If they have no other product in the bag, so to speak, it just doesn't make a whole lot of sense, and ultimately it's highly accretive to the acquirer. For smaller products, dermatology is one area, but there are lots of others. You can have a small sales force. Over at Zeltic with Cool Sculpting, we had a sales force in place for many years until we were acquired by Allergan. So I think that you have to sort of understand at the outset if to what extent acquisition is going to be actually part of the business plan. I do kind of agree with you that coming in and saying, for many companies come in and say, oh, you should invest now because we're going to be sold by the time you'd like to invest in the future. And, after you've heard that about 150 times, you're probably less. Some of the times you're wrong, sometimes you're right. But the odd thing about biotech is there's less M&A than you would think. There are roughly 25 deals a year. The lion's share of the capital's in 3 or 4 of the deals. They're split evenly on the public side and the private side. Last year, it was a dearth of M&A. So the odds are with you if you are saying, like, what is the company planning on for the long run? Just because M&A doesn't occur so much, it typically occurs either very early or very late and not so much in between, because if any of you is the head of business development at Pfizer, the last thing you want to do is pay some astonishing amount of money and then 3 months later the data reads out and it's not what you thought it would be, and you're walking around the office and everyone looks at you like, I can't believe you paid all that money for that company. So anyway, that's what I'd say on that.
I mean, I'd say from an early stage venture perspective, it's very important, right? I mean, I think we have to underwrite our investment. And so we predict what that business will be sold for 5 to 6 years from now. I mean, I don't know that you need, 100%, granularity and clarity on, the purchase price and exactly who purchases it. But ultimately, I think the best entrepreneurs ultimately understand the asset that they're building and who ultimately it would be valuable to in an M&A transaction.
I mean, one point I'd add, because it's interesting, I've sold a lot of businesses to private equity buyers, and these are a little probably later stage than where you invest, companies 50 to maybe a couple $100 million. And I've been surprised how it's almost a 50-50 market where at the time of investing by the private equity firm, some of them go in with a clear, defined path to exit. They think about who the buyers are on the back end on the day they're writing the check on the front end, whereas others just fundamentally say, this is a business that I believe has a lot of runway, has a value proposition in the broader healthcare world, and I'll sort of just let it figure itself out because I know I'm going to hold it for 3 to 5 years anyway, and I don't need to get too bogged down. And I've been actually a little surprised how it's almost 50-50, at least in my experience, in terms of how, again, slightly later stage investors think about that.
Great. Open it up to Q&A. Right over there. You.
So I'm a physician. A lot of my friends around the country are part of large physician groups, and they're being courted by various private investors. So there's obviously multiple, and second deal, whatever. How does the company being courted and invested in judge who's the best equipped to really improve their revenue and make it scalable, and so it's all a big deal for them?
You hire a banker.
Exactly. He's got a card.
Yeah, I mean, I guess it's ultimately who do you want to work for, right? Is it a large kind of conglomerate like an Optum? Is it a pure PE roll-up, right? I mean, ultimately, I think. To your point, there is a competition for the acquisition of lives, right? All across, the country in various groups, whether it be PCP groups, whether it be dermatology groups, people are competing for these lives. And there's a value to these lives, right? Whether it's, an MA life that goes for, $2,000 to $4,000 per life, there's a value. So I think you have to think about, number two, what organization you'd be a part of, but you'd also need to think about the valuation, right?
The other point I would just add is a lot of it is very specific to the makeup of your group and the goals of your group. Do you want to take on risk? So, we've seen some physician groups who are multi-specialty, have the full, assortment of capabilities, and feel they build tools, population health tools, and other things to take on risk. So that actually paints a picture of one type of partner. We've seen other scenarios where it's a targeted specialty group that, might be better served being part of the big local hospital system, might be better served being part of a complementary group. And then the other big factor that comes into play with physician groups, very candidly, is the makeup of the shareholders of the group. The average age of the docs in the group, and you tend to have a very different set of objectives for the 60-year-old docs relative to the 35-year-old docs. And managing through that can be a big exercise as well.
See, that's why you hire a banker.
Another reason why you need a banker, exactly.
So I would ask a question just from the startup entrepreneur's perspective. I lead a small company which is a startup out of Colombia entrepreneurs, basically a web-based platform connecting physicians with doctors with all the HIPAA compliant tools and stuff. When we talk to investors, we find a bipolar world of available capital from entrepreneurs' perspective. On one side, we find venture capitalists have moved from adventure capitalists to venture capitalists to becoming growth capitalists. And what we find is there the questions are often about, do you have a product market fit? Do you have revenue of X amount? Do you have X number of customers? Do you have your monthly access users about X thousand numbers? So that kind of a discussion happens when you're looking for, from entrepreneur's perspective, it's like a growth question and not really a venture question. And we miss out on the opportunity of finding people who could be funding a venture level of a company. On the other side of the spectrum, we find startups that go through accelerators or incubators, because there's so much of cookbook stuff going on that the failure rates are high, but the funding is very high. So when you start developing a company that we think are at the right value, as in real value in the company, but you're not through an incubator or an accelerator, you find that you're running very lean to the level where the growth is shown. At that time, you wonder whether you should actually go with venture capital at all, or now that you have a revenue stream, you can generate capital elsewhere, and then only go with growth when you have to. And both parties kind of miss the opportunity of meeting in the middle, where the return on equity and the growth prospects could have been very large. Why is that such a big disconnect? I understand we are not in a bubble phase of investment, but why do we find such a disconnect in a so-called efficient market?
I guess maybe if I were to repeat the question, why is it hard for entrepreneurs to raise money from early stage investors? Because they want to see a lot of proof points, I think is your question. I mean, I think it's a two-sided market, right? I think that there's a lot of capital coming into this space, and so completely agree with your barbell phenomenon, right? There's a lot of capital coming into this space. And for entrepreneurs that have achieved actual traction in the market, actually have real proof points, those valuations get bid up. I think the opposite is true, is that there's a lot of companies in this space, right? And so, as a venture investor, I probably see personally 250 or 300 companies a year that I meet with, and all these PowerPoint decks all look the same to me, right? And so, the only way that I can differentiate between all these PowerPoint decks is, talk to actual customers, right? And actually look for actual traction in the market, that you're creating near-term ROI for your potential customers, whether they be enterprises or consumers, right? So I think because there's so many companies, you need differentiators. And, to your point, there are proof points. And it's easy for a venture investor to say, oh, show me the data, as opposed to, an angel investor who may just, invest based on a personal relationship.
No, I mean, just to add to that, I've seen a lot of traditional healthcare venture investors move up to that growth type investor that you're describing because, sort of predicting adoption, particularly on the IT and services side, predicting adoption of new services or new sort of transformative business models has been really hard. Healthcare is an industry that doesn't move as fast as other parts of our economy. And so a lot of guys, frankly, lost their shirts making bets on business plans. And so now a lot of the more experienced guys are waiting to see that third, fourth, fifth client up and running, validating the product. I would say, conversely, at the earlier stage of the spectrum, I've seen a lot of companies maybe at your stage looking to beta clients and customers as possible, partners / investors. And you see a lot of hospital systems, health plans, and others who are looking to invest in key early stage technologies that they think could be part of, their future.
That's a very interesting thing, that we easily identify strategic investors that will have insight into what we do. What we also notice is you go to the strategic investors, you lose your importance as a platform.
Sure.
And many a times a strategic investor will give you early growth, early revenue, early customer acquisition, but your exit opportunities are going to be quite small because now you went with a strategic investor. Everybody else looks at you as a potential feeder to that strategic investor. That's the beauty of strategic investment. It's strategic. Whereas you want investors for the sake of investment, for the ROI, and not really for the strategic customer acquisition.
No, it's a double-edged sword, no doubt about it. And, the ideal scenario is you use that strategic investor just for that, almost seed, early round, but you obviously ultimately wean yourself away from that investor and you build a broader customer base so that investor doesn't have, the leverage over you. I can tell you as a banker, I typically, try to shy away from working with companies that have big strategic investors for all the reasons you've cited. But I've seen many companies successfully just navigate the early stages. But then, that investor owns 10, 15% of the company when it's time for exit. That's probably not going to impact your flexibility.
So, Michael, you kind of touched on the first part of my question when you asked about the vertical integration and competing for scale on the health plan provider side. But for companies that have a stated interest in developing capabilities that they want to proof inside, like CVS with the potential Aetna acquisition, do you see that as them as kind of co-investors as they go out and invest in technologies on the health IT side, or is that more competition for you and your portfolio companies?
So to reframe it, is the question that are large strategics on the investors and on the investment side competitive or not? Is that
right?
Sorry.
Yeah, I mean, having intimate knowledge of how CVS operates, you mentioned CVS is actually an investor in our fund, so we work with them closely, and they're not big strategic investors. I think that they have a lot of, kind of confidence in their ability to kind of see, strategic opportunities in the market, and they've got a lot of scale. But yeah, our fund, 2/3 of our capital was raised from large healthcare corporations, payers, providers, PBMs, health IT firms, lab firms, device firms, and they are all very active in, early stage partnership conversations. I think that they would all prefer to cannibalize themselves, disrupt themselves, as opposed to, kind of taking a standoffish view for early stage companies.
Maybe any life sciences focused questions as a last one? Go ahead, guy with the mustache.
John Meissen from NYU Stern. So I was wondering, with the new tax laws and the repatriation of a lot of money, we hear a lot of stories about tech, but we don't hear much about biotech and pharma. I was wondering what you think how this will impact the ecosystem of mergers and acquisitions, research operations, et cetera.
It's funny because it's actually the last question I didn't get to, so very well done. I had a mole planted in the audience, but it wasn't you, but I guess it was. So did you share the question? Go ahead.
So, in the beginning of the year, we did see a couple of deals, and I think that the valuations were robust, I would say. I think what it's doing is giving buyers a little bit more margin of error in terms of being able to stretch in valuation. But that being said, I don't think that this is going to be like, drunk sailors going out and buying everything out there. I don't think that that's going to happen. Companies are still very disciplined about what is strategically fitting in their portfolio, what they want. And it's just really about being able to stretch a little bit more. Definitely the whole reverse merger inversion types of structures. They stopped, a couple of years ago for the most part. I don't think we're going to see too many of those in the future in terms of life science world. And it's good for the industry. I think the bigger kind of macro perspective is that with the tax laws overall is just inflation and interest rates and what that does to the overall equity markets, and I think that could have an impact on life sciences equities, et cetera. But that's kind of another story. Drew?
No, I couldn't agree more. And I think that, to your point, I was just thinking of when Pfizer went after AstraZeneca, basically because they were a UK-based company. It was a little insulting to all the people at AstraZeneca to say that the main value was they weren't based in the U.S. I think they're a little insulted by that, but I think you're absolutely right. They're going to see a lot less of that. The repatriation, we all hope, leads to M&A. I'm hoping there is some drunken sailor buying, but you never know. We'll see.
All right. Thanks to the panel. Thank you very much.